Okay, welcome to IAS 40 Investment Property. Now we'll see the last few paragraphs related to disclosures. There is a long list of disclosures here. First few disclosures mentioned here are common, whether it is a cost model or fair value model. Okay, so following general disclosures will apply. First is you have to disclose accounting policy, because there are two models possible. Better you describe your accounting policy for measurement of investment. You can apply fair value model or you can apply cost model. Whichever model you can follow, you can follow, but then you have to make a disclosure. Then in situation calling for exercise of judgment for classification of a property as investment property. Do you remember some situation which calls for judgment? 50% is owner occupied, 50% is given on rent. Or a hotel where services are also provided to the guest. Like this, 6 months you have used it, 6 months rented out. The criteria adopted to distinguish investment property from owner occupied property and from property held for sale in the ordinary course of business. So you have to write the reason why you have chosen it as investment property, why you have not taken it as either owner occupied property or inventory. The extent to which fair value of investment property as disclosed or measured in the financial statement is based on a valuation by an independent valuer. So in case if you have used an independent valuer for fair value of investment property, disclose who holds a recognized and relevant professional qualification and has recent experience in the location and category of investment property being valued. So in case if you have appointed a professional, then these disclosures will be required: qualification, experience. If there has been no such valuation, that fact should be disclosed. Next is the amount recognized in profit or loss. What are the amount you can recognize in profit or loss? For example, including means this list is not exhaustive. Rental income from investment property, any direct operating expense arising from investment property that generated rental income and those which did not generate will disclose separately. Direct operating income from investment property that generated rental income and those which did not generate, disclose separately. Then existence of any restriction on the realizability of investment property and contractual obligation to purchase, construct or develop investment property or for repairs, maintenance or any enhancement. So in case if there is any restriction on the sale of investment property, government may put a restriction or for whatever reason give a disclosure. The purpose of this is that there is a risk involved because the realizability is restricted. Okay, so this disclosure will help the investors. In case of any contractual obligation, give that disclosure also. It helps us to understand the risk and return better. Last line I think is a repetition. You can delete it. Contractual obligation to purchase, construct or develop investment property or for repairs, maintenance or enhancement. 2 lines are repeated. Now come to additional disclosures. Under that A, fair value model. So if you are using fair value model, there is a long list of disclosure requirement. An entity that applies the fair value model shall disclose a reconciliation between the carrying amount of the investment property at the beginning. So you write opening balance and you reach the closing balance. Whatever adjustment you have done during the year, for example, addition, deduction, disclosing separately those addition resulting from acquisition and those resulting from subsequent expenditure recognized in the carrying amount of the asset. Any addition resulting from business combination, asset classified as held for sale or included in a disposal group classified as held for sale in accordance with IFRS 5 and other disposals. So plus minus net gain or loss from fair value adjustment. Again, it can be plus or minus. Net exchange difference arising from the translation of the financial statement into a different presentation currency and on translation of a foreign operation into presentation currency of the reporting entity. So that may also affect your carrying amount. Then transfer to and from inventory and owner occupied property. So what they are actually telling you, opening balance and all these adjustments which are possible and other changes. So this will give you closing balance. When a valuation obtained for investment property is adjusted significantly for the purpose of financial statement, for example, to avoid double counting of asset or liabilities. Give me the example. Suppose there is a factory or there is a building, but it has got a lot of furniture, equipment, ACs, and those you have valued separately. So then it will require a significant adjustment in the investment property value that are recognized as separate asset and liabilities. The entity shall disclose a reconciliation between valuation obtained and adjusted valuation included in the financial statement, showing separately the aggregate amount of any recognized lease liabilities that have been added back and any other significant adjustments. See, this will be explained like this. This is the fair value of the property, and from this you deduct, suppose, the value of equipment minus furniture, and that will give you adjusted fair value. Okay, so any plus minus that you have done, which you have shown separately, you have to show a reconciliation between the full fair value including all this equipment, furniture, AC, etc., liability also included, and those items which you have presented separately. Give the reconciliation. In the exceptional cases, when the entity measures investment property using the cost model, as we discussed earlier also, cost model is exceptional under IFRS. Fair value is normal, or in accordance with IFRS 16. The reconciliation required shall disclose amount relating to that investment property separately from amount related to other investment property. In addition, the entity shall disclose a description of that investment property, an explanation of why fair value cannot be measured reliably, and if possible, the range of estimates within which fair value is highly likely to lie. This is for those investment property which have been valued using cost model. These are the disclosure requirement. On disposal of investment property not carried at fair value. On disposal of those investment which are not carried at fair value, disclosure is: 1. The fact that entity disposed of investment property not carried at fair value, that we have sold this property, it was not carried at fair value, the carrying amount of the investment property at the time of sale, and the amount of any gain or loss recognized. Do you need to by heart all this? No. In case if they ask you, you can refer this place. And now the last part of this wonderful chapter, disclosure requirement relating to cost model. In case if you have followed cost model, following additional disclosures: depreciation method used. Most of these disclosures are similar to IAS 16. Okay. Useful life. In case if you have depreciated on the basis of useful life, or in case if you have depreciated using rate used, gross carrying amount, accumulated depreciation, accumulated impairment loss at the beginning and at the end, a reconciliation of carrying amount at the beginning and at the end. Same disclosure. Addition, disclosing separately those addition through business acquisition, other acquisition or by way of separate expenditure. Then addition resulting from acquisition through business combination, that is IFRS 3 should be applied here. Asset classified as held for sale or included in a disposal group in accordance with IFRS 5. The next is depreciation. Amount of impairment loss recognized and the reversal thereof if any during the period. Then no net exchange difference in your notes. Net exchange difference from translation of financial statement to a different presentation currency and on translating to presentation currency of the reporting entity. Then there can be some transfer to and from inventory and owner occupied property. That will also come under disclosure, and any other changes. Last, disclosure on cost model. For investment property accounted for under cost model. Now this is a very important line. In case if you have followed cost model, you have to also disclose the fair value of the property. And when such fair value cannot be reliably determined, you have to give additional information. For example, description of the property, explanation why fair value cannot be determined, and third, if possible, the range of estimates within which the fair value is highly likely to be. Okay, the same thing was mentioned in the fair value model also. So this disclosure requirement is very long. And now one good news, differences between Ind AS 40 and IAS 40. You will not find major difference except the valuation models. IAS 40 permits both the cost model and the fair value model, except in some situation. For measurement of investment property after initial recognition. So this is the key difference. IAS 40 fair value and cost model, whereas Ind AS 40 only cost model. Fair value model is not allowed. Why? Real estate business in India is not yet sophisticated. Okay, so there are difficulties. This is what the standard says in measuring the fair value of the real estate. Okay, unofficially they should have written, because real estate transactions involve many times some unaccounted money also, and if you disclose the fair value very clearly, then there can be a problem for the entity. Is it right? Don't write that. Now we'll solve one last question. In your book it is question number 16. Okay, question number 16, and then remaining few questions. Note down homework 17 till 21. X Limited has the following 4 properties. Okay, property A used as office building. So what is the original classification? If used as office building, it will be PPE, owner occupied property. Okay, cost rupees 30 crore, depreciation accumulated 20 crore, net rupees 10 crore. The company puts the property into renovation and intended to lease out under one or more operating leases. Now you see one last line below. How should the transfer be evidenced? How would this transfer change the classification of the respective property? So what is the change here? You have to tell me dash to dash. Property, plant, equipment to investment property. Let me check whether you are right or not. Answer A. The classification will be owner occupied to investment property, and in this case the original cost, accumulated depreciation and the net carrying amount would not change. So the same value will be assigned to investment property. Same carrying amount will be assigned to investment property. Okay, very good. You seem to be learned people. Property B, used under operating leases. Used under operating leases, cost rupees 50 crore, depreciation 20 crore, net rupees 30 crore. The property is put into renovation for sale. Put into renovation. First they will renovate, and after renovation is over, then they will sell. So my question is same, dash to dash. What is the current classification? Investment property. What will be the proposed classification? Held for sale or inventory? Okay, second question we'll discuss later. Property C, used under operating lease. Same question, cost rupees 40 crore, depreciation 20 crore, net 20 crore. Properties put into sale. So dash to dash, fill in the blanks. Operating lease right now, investment property 2. Both will be held for sale, or this will be inventory and this will be held for sale. So you have not yet studied IFRS 5, but in IFRS 5 you will study then an asset is treated as held for sale if it can be sold in its current condition. This one will be inventory, because there is a condition. You are going to first renovate it, okay, and thereafter you would sell it. Here it will be put into sale, means held for sale as it is. Now see the answer. The property shall be valued at. Now here the classification will change from investment property to inventory, because it is not going to be sold in its current condition. There is a renovation that is going to happen. So in IFRS 5 you will learn property should be ready for sale in its current condition, and it will be valued at cost or NRV, because now you want to sell it, so it's available. Why no PP?
Because can't consider it is not satisfying the conditions for disposal for sale, then PPE, because it is not an investment broader concept.
But now it is going to be sold, so it will be renovated and sold. But in case of inventory, some expenditure can be incurred to make it ready for sale, na? That is not the only definition of inventory. Inventory can be used as finished goods, WIP, raw material. So it requires some more expenditure and then it will be sold. Inventory is not always in a ready to use condition to be sold. It is in ordinary course of business now only. It wants to renovate, and so it can't go to which heading? It cannot go to property, plant and equipment now, because we want to sell it now. It can't go to held for sale category also, because it is not in a position that you can sell it as it is. So that means you are going to sell it, but before selling you are going to incur some expenditure. Then third category. In third category, what was your answer? Let us check. In the case property C, depreciation charge would continue till the asset is classified as held for sale. This is right. Depreciation charge would not arise and the asset shall be measured at fair value less cost to sell. Only make a correction in your note here. some typing error. It will be investment property to non-current asset held for sale. Non-current asset held for sale. And if it is non-current asset held for sale, then it will be valued at carrying amount or fair value less cost to sell, whichever is lower. What is the fourth example? Property D is used under operating lease. Cost 40 crore, depreciation 20 crore, net rupees 20 crore. The property is put into renovation and intended to be used as office building after the renovation. What will be the classification now? Investment property to owner occupied property. So what is the amount at it? It will be transferred to owner occupied property. Same, carrying amount to carrying amount. Okay, no gain or loss will arise. And in future, you have to provide depreciation. This standard is over. Okay, homework. Question number 17 to question number 21. Only 5 questions. Will you be able to read? Solve. Okay.